We've got an exciting show lined up for you, with a focus on the latest developments in the stock market. Recently, there have been some interesting trends and patterns emerging that could have a significant impact on your portfolio. From the Nasdaq Composite's rare 4-day winning streak to the potential for a skyrocketing market over the next year, we'll be exploring it all. First, let's take a look at the Nasdaq Composite's impressive run. This technology-driven index has been leading the way with a year-to-date gain of 13.4%, outpacing the S&P 500 and the Dow Jones Industrial Average. But what's really caught our attention is the fact that the Nasdaq has now achieved something that's only happened 18 times since its inception in 1971, 4 consecutive daily gains of at least 1%. According to historical data, when this rare event occurs, the Nasdaq tends to perform exceptionally well over the next year, with an average gain of 29.3%. That's significantly higher than the index's average annual return of less than 11% over the past 55 years. If history were to repeat itself, we could see the Nasdaq Composite soaring above 34,000 by August 2027. However, it's essential to keep things in perspective and consider the potential risks and challenges that could impact the market. The AI infrastructure build-out, which has been driving much of the recent growth, could be slowed down by Federal Reserve rate hikes or a decline in spending on AI chips, memory, and servers. Additionally, the stock market is currently trading at historically high valuations, with the S&P 500's Shiller price-to-earnings ratio nearing 43. This means that companies will need to deliver sizable earnings beats to maintain these premium valuations. As we navigate this complex landscape, it's crucial to remain cautious and informed. We'll be keeping a close eye on these developments and providing you with expert analysis and insights to help you make the best decisions for your investments. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into a fascinating story about Warren Buffett's successor, Greg Abel, and how he's handling the massive cash pile built up at Berkshire Hathaway. It appears that Abel is taking a slightly different approach than his predecessor, with the company's cash reserves shrinking last quarter as he ramps up spending on stocks and buybacks to multi-year highs. Now, this raises an interesting question. Is Abel being more aggressive in his investment strategy, or is he simply trying to make the most of the current market conditions? Some might argue that Buffett's cautious approach was what made Berkshire Hathaway so successful in the first place, while others might see Abel's move as a necessary step to stay competitive in today's fast-paced business environment. It's also worth noting that Abel's decision to use cash for acquisitions and investments, rather than issuing new shares, is a deliberate choice that reflects the lessons learned from Berkshire's past mistakes. The infamous Dexter Shoe Company acquisition, which Buffett has called one of his biggest errors, is a prime example of how using undervalued or appreciating stock as acquisition currency can lead to exponential losses over time. As we consider Abel's strategy, it's essential to remember that every investment decision carries risk, and even the most experienced investors can make mistakes. However, by being aware of these risks and learning from past experiences, we can make more informed decisions and strive for success in our own investments. In conclusion, Greg Abel's approach to managing Berkshire Hathaway's cash pile is a topic worth watching, as it may signal a new era for the company. Whether you're a seasoned investor or just starting out, it's crucial to stay informed and adapt to changing market conditions. Welcome back to the Riskwiser Zone. As we wrap up today's show, let's take a closer look at some of the key market movements that caught our attention. Emerging market stocks and currencies have been on the rise, thanks in part to the soft U.S. jobs data released last Friday. This unexpected twist has eased expectations for Federal Reserve rate hikes, giving emerging markets a bit of a boost. The MSCI gauge of developing market stocks is up 0.7% in early trading, with Indonesia's rupiah leading the charge. Now, it's essential to keep things in perspective. As Wei-Kun Chong, senior Asia-Pacific market strategist at BNY, pointed out, the strength of emerging market currencies is mainly driven by the drop in the US dollar last week. So, what's next? All eyes will be on the US consumer price data due later this week. This will be a crucial catalyst in determining the near-term evolution of the US dollar and, subsequently, EM currencies. In other news, San Miguel Corp's controlling shareholder, Ramon Ong, has agreed to buy a 25.7% stake in Lopez Inc., a privately held conglomerate with interests in energy, real estate, and media. This move follows a leadership dispute within the family-owned company and may help restore family peace, as Gabby Lopez put it. As we navigate these market developments, remember that investing is a marathon, not a sprint. It's crucial to stay informed, but also to avoid making impulsive decisions based on short-term fluctuations. So take a deep breath, assess your portfolio, and consider your long-term goals. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, keep your finances in check.